Hi, good evening to everyone. Thank you for coming today. So 𝗪𝘃 said at the start of the evening that fixed income is back. So it's great that now we have representatives from 3 award-winning funds today, from Allianz, Manulife, as well as 𝗪𝘃𝗲𝗀 to share their thoughts. So perhaps to kick things off, we'll give the floor to each one of you for the same question. How would each of you describe your fund and your investment methodology? Perhaps we could start with you, Alvin.
Sure. Good evening, everybody, and thank you so much for taking the time to attend the award ceremony. So, just to give a few quick summary of our fund. Our fund it manages it invests in Asian bonds, primarily in investment-grade bonds. It's low volatility, and it looks to provide a stable stream of income. In terms of where we see the key drivers of returns. Three parts. Firstly, rates. Secondly, credits, and then lastly, FX. For rates, we are very active when it comes to managing the duration on the portfolio. In a rising interest rate environment, this is where we try to protect the portfolio from significant drawdowns. The fund can also take up to 20% in Asian local markets. Then this is where we leverage on our sizable presence in Asia. We have more than 60 over fixed income professionals spread across 10 different local markets in Asia. And we look to generate alpha by our local exposure in rates and currency. And for credits, we have more than 20 over credit analysts covering more than 500 over Asian issuers. Every single credit that we buy has to be approved by the credit research team. And this is where we select the strongest credits to construct the portfolio.
Same question for you, Jason. How will you describe your fund?
Okay, thanks everyone again for your time here, and of course thanks to Fund Supermart for inviting us to be here. I guess again, for us, a few sentences, I think we can just describe in 3 words, right? As the name for the Allianz Global Opportunistic Bond is, it's global, it's opportunistic, and it's a bond, right? Of course not that. Okay, basically, for us, definitely in terms of quality, we want to make sure that the fund itself is definitely of the highest quality. So minimally, it's always kept at investment grade and above. So right now, as I speak, it's about AA+. So 1 tier just below the case of our Singapore Treasury, same level as the US Treasury. And then obviously, at the same time, we do want to make sure that it's global, which is unconstrained. So really what we want to highlight here is that we can generate returns by sourcing from different drivers, not just from your credits, but not just also from your currency, but across the rates, the yield curve, as well as duration. So that's the second aspect. And then thirdly, is really the opportunistic area, whereby we can actually derive return drivers, not just depending on credits, which tends to be a bit more isolated. All right, we are able to generate these kind of returns independently of these broad bond markets. So that is basically the description of the fund. And of course, in terms of the investment philosophy, I think that's also something that I can just describe within 4 words, winning by not losing. And that's why I guess Fund Supermart has chosen us to be the best risk-adjusted returns for the global bond group. And thanks for the recognition. Okay, because again, for us, if you all know Allianz, Allianz Global Investors is part of the Allianz Group, which has been around for the last 130 plus years. And risk management is definitely in our DNA. So that's number 1. And then followed by in this, of course, in the event, in terms of generating returns, we want to make sure that we are able to generate the kind of returns, okay, by sourcing the best opportunities that are able to give you the best risk-reward profile. So that's also something that, again, we wanted to highlight the investment philosophy of the fund.
Thank you very much for the comprehensive explanation. So Darius, how will you describe your fund and its philosophy?
All right, I feel very disadvantaged being the third person because if we are talking about fixed income, no one comes up here and says, I buy lousy bonds, right, rubbish stuff and all that. So I think pretty much, my name is Darius, by the way. I'm from 𝗪𝘃𝗲𝘀 Asset Management. So we are very happy and delighted to be awarded the award for the short-term bond fund. So rather than regurgitate what my previous panelists have all said, so obviously we do the same things, we buy great quality bonds and all. The one distinction about us is we are short duration. So this has really worked last year, especially when interest rate was rising. Many of you have actually switched into our funds simply because you want to avoid getting that NAV erosion as interest rate goes up. But tonight we want to keep things a little bit light, a little bit more friendly. So I'm going to take a leaf out of John Paul's booklet and talk a bit about food. So our fund, if you like, you can think of it as economic 𝗪𝘃. Right? It's plain. It's not meant to do anything special. It's there to fill your stomach and get you exactly what you want. No surprises unless you want something a little bit spicier, but then that's about it, right? So for us, that's exactly what even FSMOne has done, put us into the Cash Plus account, so on and so forth, and we are essentially doing what we're supposed to do. Keep your money safe, give you a good return, and at the end of the day, you can take the money and go and buy 𝗪𝘃 also, all right? So I'll leave it as that.
Okay, that's great to hear. It's our favorite 𝗪𝘃 fund. So diving deeper into the funds, perhaps we'll start with Jason on your Allianz fund. So your Allianz Global Opportunistic Bond Fund is unconstrained. So basically you have access to the whole bond universe. So my question is, within such a large universe, how do you narrow down your best picks?
I guess it really boils down or anchor down to this investment process that we have applied consistently over the course of the last 35 years, and he has definitely been able to identify the superior performing countries, credits, as well as also the currency. Now, of course, not just that, we do have in-house our own proprietary leading indicator tools that's able to distill a wide array of all this market data and then forecast in terms of where we are at the market cycles. And then, of course, at the same time, talking about monetary policy, growth dynamics, and inflation. So I think this is something that is very pertinent to this current economy. But not just on the macro front, but at the same time, we have this proprietary credit tool that has been able to correctly predict any distress 100% over the course of the last 35 years. So this is really putting all together, plus, of course, as I mentioned, the risk management process. This is definitely one whole wide array of tools and, and the case of the risk management process that is allow us to really identify the best picks within the whole entire fixed income space.
That's great to hear you have such a comprehensive process. So, similar question for Alvin. So for your Manulife Asia Pacific Investment Grade Bond Fund, so the Asian investment grade bond space is also pretty big. So you have a lot of countries inside. You have, for example, your hard currency versus local currency. So my question is, what does your investment process look like?
Sure. So investment process, it's very systematic. It's repeatable. It's scalable, and it's transparent. It's basically a combination of a top-down and bottoms-up approach. For top-down approach, that's where we have macro calls on rates, currency, as well as our country allocation. This is where we have regular meetings and calls with the local PMs and analysts who are based in the 10 different markets in Asia. The analysts and the PMs would then give their their 6 months, 12 months forecast on where they think their local government bond yields, where credit spreads, and where the FX would trade in the medium to long term. And this is where this is where we actually create and actually choose the best ideas from all the local teams to determine the best risk reward potential for each of the local markets. And then for the bottoms-up approach, this is really where our credit research team, that's where they do their fundamental analysis on the credits that they cover. Our credit analysts, we have more than 20 over credit analysts covering more than 500 over Asian issuers within the region. And every single credit that we buy has to be approved by the credit research team. So basically, we select the strongest credits to construct our portfolio.
Thank you very much for the response as well. So moving on to you, Darius. What does your Shenton short-term bond fund's credit selection process look like, especially with what you mentioned about preserving capital?
Right. So again, we're talking about fixed income here. So the secret sauce or the way of preparation doesn't differ very, very much. Again, similarly, we have a proprietary framework which we call FVT. So it's fundamental, valuations, and last but not least, of course, when you look at our process, we're supposed to manage the whole top-down scenario versus the bottom-up scenario. So if I were to again then expound on my little 𝗪𝘃 example, just to make it a little bit more palatable and understandable for everybody. Today, for example, if chicken is expensive, maybe we cook less chicken dishes. right? We buy more pork, we buy more other things within the portfolio. If today the macro environment is worried about eating fish, anyone worry about eating fish today? No? No one? Okay, y'all didn't get the joke, never mind. But if you're worried about eating fish, then we cook less fish. We basically buy something else, and we do that within the portfolio itself. But I think similarly to what Alvin has shared, I mean, most firms, we are very, very well resourced. You know, we have a team of outstanding personnel who has been with the company for a very, very long time. And again, to put it in perspective, for the short-term bond fund, how we're able to do what we're able to do is we have this fund manager who's been with us for a very long time. And in fact, in one of the years previously, he's attended a competition and he's won, you know, most astute fund manager of the year. So I can basically put it, if I were to put it in a culinary experience, he was best chef ever, you know, most creative chef. So I think that's what we are trying to do, put the best people, put the best method of preparation, and essentially, again, deliver to you what we promised to deliver, which is short duration bonds, high quality, and outstanding returns.
Thank you very much to all of you for the explanation of how your fund works. I think it's very clear that for all three of these funds, they all have a very comprehensive process behind them. They have a very strong team behind them as well, and that's how they have been able to do so well over the past few years. So back to Jason. So a bit more macro color. So we've seen the ECB and BOE, for instance, hike rates recently, and the tail of the past year has all been about rate hikes. So what do you think about these rate hikes, and how are you positioning your portfolio?
I guess it's definitely absolutely right. Since last March, right, we have started to see the rate hikes coming through, led by Fed, and then of course the ECB, and even recently we have seen BOJ, which has been keeping their stance pretty constant over the course of the last 1 year. They have also shifted their yield curve control. So I guess again, for our view is that we perhaps see that the tail end of this rate hike cycle. But having said that, perhaps we can still expect 1 or 2 more rate hikes, especially if we see that inflation numbers still continue to be sticky. So in terms of how we are positioning the portfolio, okay, one thing that we have seen over the course of the last 30 plus years is that whenever there's a rate hike, okay, the rate hike's impact on the real economy tends to be lagging about 1.5 years to 2 years. So if you were to think about that, since last year we have seen the rate hikes coming through, perhaps the growth in terms of the economy will start slowing down perhaps in the 4th quarter or even 2024. So that is something that we are trying to position in terms of our portfolio. So on 6 months to a year kind of horizon, we are in fact favoring more, and we are more constructive in terms of sovereign bonds. So how do we position our portfolio is increasing duration, okay, by buying into a basket of such sovereign bonds.
Thank you. So thank you for the response on the global color from US, Europe to Japan. So moving on to Alvin on your Manulife fund. So China is a big part of the Asian IG space. So my question is, how is your Manulife fund positioned within China and also outside of China?
It's a really good question. So firstly, you know, China is the 2nd largest economy globally. It's also the biggest weight in the JP Morgan Asian Credit Index, now short form known as the JACI, and that is an index consisting of Asian dollar bonds, which is widely followed by investors. So we basically have a very strong presence. You know, we have a strong presence in China, and we have a very strong credit selection process. So we look to identify sweet spots where can generate attractive returns without taking excessive risks. We also focus on the different state-owned enterprises of different levels, as well as high-quality, privately owned corporates within the tech and manufacturing sector. Now, outside of China, we like Australia as well as Korea. Within Australia, we like the financials and commodity sector. And within financials, we like the bank tier 2 papers. Typically, these banks, they have very strong credit fundamentals. They have strong corporate governance as well as strong sustainability attributes. And many of these papers, they trade quite attractively compared to their global peers. In addition, the JACI index has also created an enhanced index just a few months ago, where they've also included Japan, New Zealand, and Australia. So we think the technical supporting these Aussie papers would be supportive going forward. For Korea, we have seen quite a healthy supply over the past 1 year or so, and we have taken an opportunity to buy some of these issues coming in the primary market. They have been providing very attractive concessions, and their credit fundamentals have also been pretty stable.
Thank you for providing so much color within Asia itself, from China, Korea, Australia, and so on. So Darius, this question is for you. So I think we've seen with the rate hikes, short-term yields have gone up quite a bit, and your portfolio yield is about over 5%. So do you think investors can continue enjoying these yields moving forward?
Well, unfortunately, I would say the answer is no. So in case you guys didn't hear, yes, while portfolio yields are around 5% right now, but obviously yields have been decreasing. Now, let me just paraphrase that, because obviously Jason has talked about the US continuously hiking rates. There are another 2 hikes more to go. But if you actually look at the Asian landscape, none of the countries are actually hiking rates anymore. In fact, 0. So most of the countries are actually slated to cut interest rates. So Singapore, we're expecting, or rather, we've already started to see that. So anyone here managed to secure fixed deposit at 4.5? Some of you, 4.5 fixed deposit, there you go. Yeah, but if not, it's been dropping, 4.3, less than 4 now. I mean, even countries like India, Philippines, Malaysia, so on and so forth. Everyone, if they're not cutting within the next 1 to 2 quarters, they are going to reduce interest rate in the beginning of next year, so on and so forth as well. So, frankly speaking, can we continue to see 5%? The answer is really no, because as everyone cuts, there lies the danger. But it is also great to be in the short-term bond fund at this period, because as interest rate is being cut, your portfolio valuation is also going to go up. So what you kind of lose in terms of the yield, you will get back in terms of the portfolio valuation itself. But again, not to confuse the strategy with my counterparts over here, they are obviously managing it on a very, very different basis. But for short-term bond fund, we have the flexibility to go anywhere from 1 year to 3 years. So just as an illustration, when interest rate was being increased last year, our portfolio was at 1.5 years. So a little bit on the high side. We immediately cut that down to 0.9, which is also why the fund did very, very well. And you got quite a fair bit of returns as interest rate went up. Right now, we're holding it about 1 year. So it continue to go upwards and so on and so forth. Once all of that is done, we can even stretch our duration to 2 years, for example, 2.5 years, so on and so forth. So we have a bit of room to play, but long story short, we are not going to see that high number being repeated, maybe in another year's time, in 2 years' time. But that said and done, I think we will land up around the 3.5–4% kind of a mark still, which I think is pretty decent for anyone who is looking for that kind of a number as your baseline expectation.
Okay, that's good to hear that we are at least at 3.5–4% even as we move forward. So I guess one final question for each of you here. Maybe we'll start with Alvin. What do you think are some key aspects of the Manulife Asia Pacific Investment Grade Bond Fund that everyone should know about, and how can they fit within a diversified portfolio?
Yeah, it's a really good question. I think just to add on what Jason mentioned earlier, we are towards the end of the rate hiking cycle by the global major central banks. We think that the backup in yields, as well as the additional spread provided by Asian bonds, provide really attractive entry levels for Asian bonds. So we think that Asian bonds should be a core investment in investors' portfolio. For our fund, we have a very diversified portfolio where it's low volatility, and also look to provide a stable stream of income. It is CPF approved, and it's also a very strong track record. If you look at the year to date, past 1 year, 2 years, 5 years, we are ranked top quartile within our peer group. So just to sum up again, we think the backup in yields as well as the spread provided by Asian bonds makes it very attractive for investors. We think it should be a core asset in an investor's portfolio, and we think our fund is well positioned to do so.
Thank you. So it should be a core asset allocation in your portfolio, and this fund has certainly done well over the past few years. Moving over to Jason, similar question. What do you think are some key aspects of the Global Opportunistic Bond Fund that every investor should know about?
I guess, again, what I highlighted earlier on is the most important thing in terms of winning by not losing. So that is one key aspect for us when it comes to talking about risk management, while also at the same time generating returns for our clients. So I think one key aspect of also the fund, other than being the best risk-adjusted returns in terms of global bond, is also the case is that if you were to look at us versus many of our global bond peers out there, we tend to not rely so heavily on credits, because we do see that there's a lot more opportunities in the entire fixed income space beyond credits in order to generate returns. And of course, more importantly, having a good credit yield does not equate to good returns, all right? There can be a lot other of return drivers that you can actually tap onto that is across differing market cycles. And this is something that I guess one of the key aspects of the fund, other than what I've mentioned earlier on.
Thank you very much. I love the slogan, winning by not losing, because I think everyone here likes to win more than they lose. And I think this Allianz GOB, Global Opportunistic Bond Fund, has certainly done quite a bit of winning over the past few years. So, Darius, same question for you. What are some key aspects that everyone should know about?
Right, so in terms of the 𝗪𝘃𝗲𝘀𝗁 short-term bond fund, I think right from the very beginning where I used the illustration of a economic rise type of, is meant to do exactly what it's supposed to do. So I'm so thankful that both my counterparts here have not stolen the one line I hope that they wouldn't say, but John Paul and 𝗪𝘃𝗀 just now said it already. Ladies and gentlemen, it's been 10 to 15 years where we can finally, first time ever, say fixed income is a tactical opportunity, right? So I think our counterparts here, I mean, if, from Allianz as well as from Manulife, they have products which are a little bit longer duration. So those are opportunistic things that you can tap upon simply because if interest rate cuts, you multiply by the longer duration, you get a nice bump up in NAV. So where does the short-term bond fund play? It's really a little small space where you keep everything safe for that 10 to 20%. And then you just do what you are supposed to do with that 10 to 20% while taking on risk from all the other portfolios. So really we're like a parking vehicle, if you like, or if you're uncertain and you don't know what to do with your money right now, because as you heard from the first panel, Christopher and all that sharing, right, where maybe markets are going through recession and all that, and it's going to give another 10, 20%. So what you may want to do is get out of equities, put it into this fund, ride it out, and then at the end of the day, redeploy back when you get a little bit more certainty within the market. But I feel that as the last person on this panel, I got a little bit more moral obligation to lift the mood of everybody up. So allow me to just put down the mic and try this. Can you all hear me if I don't use the mic? Yeah. Brilliant. So I wanted to just share, at the end of the day, investing though, whether in fixed income, short-term, long-term, equities, really should be a? Oh, come on, there are 200 of you in the room here. It should be a habit. So what's a habit? A habit is this. If you forget it, you are always left with a bit, that's right. Because at the end of the day, you have the bit because you are stuck with it. And so whether you're invested in equities, fixed income, I believe that you will find a right way to portfolio allocate so that when investing becomes a habit, no matter what happens, you will forget it, you will leave it to one side, but habits always have an interesting way of coming back. That's where you clap loudly now. Thank you very much.